Silver futures on COMEX just plunged 15% in a single session last week, wiping out 67 million ounces in forced liquidations. But physical dealers report premiums spiking 40% above spot, with wait times stretching to weeks for delivery. Shanghai exchanges are bidding $85 per ounce, while paper trades limp at $72. Industrial buyers, solar manufacturers, AI chip fabricators are quietly locking in contracts at any cost, draining vaults faster than mines can produce. This isn't a correction. This is the paper system fracturing in real time, exposing a 300 million ounce global deficit that no amount of margin hikes can paper over. Look at the sequence. December 2025. CME Group, the overseers of COMEX, hikes silver futures margins 3 times in a month, culminating in a $25,000 per contract requirement. That's not routine maintenance. That's a kill switch activation, designed to force leveraged longs out of the market and crash the price before deliveries hit critical mass. They did it overnight, without warning, echoing the 1980 Silver Thursday, when rules were rewritten mid-game to bankrupt the Hunt brothers. Back then, it worked because the rally was speculative, driven by 2 men cornering the market. Today, the squeeze is structural. Industrial demand outstripping supply by 1.1 billion ounces annually, compounded by China's export ban effective January 1st, 2026. The banks thought they could repeat history. Instead, they accelerated the decoupling. Paper prices tank, while physical metal vanishes into private vaults and factories. This divergence isn't accidental. It's the symptom of a system where banks have sold promises they can't fulfill. JP Chase filed an emergency SEC Form 8K on December 27, 2025, disclosing a $4.875 billion unrealized loss on silver positions. That's not a trading error. That's the cost of maintaining a massive short book in a market where physical scarcity is biting back. For years, bullion banks like JPM, HSBC, Scotia, and BNP Paribas dominated COMEX, trading paper contracts that outnumbered actual metal 250 to 1. They leased silver from vaults, rehypothecated it across derivatives, and suppressed spot through coordinated shorts. As long as leasing rates stayed low and industrial users played along, the illusion held. But 2025 changed everything. Silver surged 145% year-to-date, from $29 to highs near $100, driven by photovoltaic cells and AI hardware consuming record volumes. Central banks bought gold at unprecedented rates, but silver, undervalued at a 58 to 1 ratio to gold, became the bottleneck. Now, the banks are exiting. Reports confirm JP Morgan, HSBC, Scotia, and Paribas are pulling out of COMEX silver trading. Without these players, the exchange shrinks to irrelevance, like a flea market in a global bazaar. Why bail now? Basel III regulations reclassified silver as a Tier 3 asset, slapping an 85% required stable funding (RSF) score on unallocated positions. That means banks must hold massive cash reserves against paper silver, eroding profitability. The manipulation game, shorting futures to cap spot, suddenly costs more than it yields. Physical holding mitigates the penalty, but vaults are emptying. COMEX eligible stocks drop below 100 million ounces, while open interest implies claims on 3 times that. If you're in banking or risk management, you've seen these mismatches before. Tell me in the comments how your models are handling this shift from paper to physical. Trace it back. The 1980 rule change was a blunt instrument. Silver Rule 7 jacked margins and forced liquidation, collapsing prices 50% in days. It saved the banks then because demand was artificial. But 2025's hike, 10% mid-December, then doubled effectively by month's end, triggered a flash crash to $73.72, yet failed to replenish vaults. Why? Because the buyers aren't speculators on margin. They're Tesla locking in solar inputs, Indian conglomerates stockpiling for electronics, sovereign funds diversifying from fiat. China's ban isn't isolationist, it's strategic, securing 70% of global supply flows for domestic needs. When Beijing requires export licenses, it starves Western markets, pushing premiums higher. Meanwhile, UBS flipped bullish on silver, recommending longs as hedges against currency debasement. Even banks sense the tide. Their shorts are covering, but not fast enough. This isn't isolated to metals. It's intertwined with broader fractures. U.S. national debt hit $38.85 trillion as of January 6, 2026, with interest payments at $1.2 trillion annually, more than defense spending. The Treasury faces $7.6 trillion in maturing debt over the next 2 years. But foreign buyers like China and Japan are retreating, Pivoting to gold and silver. BlackRock's 2026 outlook, released December 2nd, 2025, went tactically underweight on long-term U.S. Treasuries, citing exploding debt service and buyer fatigue. Yet, they're overweight U.S. equities, betting on AI-driven productivity to outpace government insolvency. Apply that to silver. Institutions are underweight paper futures, but accumulating physical alternatives. Gold as a tactical diversifier, in their words, but silver, historically undervalued, offers asymmetric upside. The firm's push into commodities and infrastructure signals the same. Tangible assets over fiat promises. When the world's largest asset manager prefers Canadian bonds or Eurozone debt to U.S. Treasuries, it's a vote of no confidence in the dollar's stability. Silver amplifies that. Its industrial utility makes it a dual hedge against inflation and supply chain collapse. Consider the historical mirror. The 2008 crisis started with mortgage-backed paper imploding when underlying assets soured. Here, silver's paper tower, futures, ETFs like SLV settling in cash, crumbles as physical drains accelerate. Back then, banks got bailed via TARP. Today, the Fed's $34 billion emergency injection last week was labeled market stability, but whispers tie it to covering silver margin calls. A major institution missed one at 2 a.m., triggering algorithmic liquidation that dumped prices 10% in minutes. That's not free market discovery. That's intervention preserving the status quo. But it backfired. Retail stackers on platforms like Reddit's Silverbugs bought the dip, moving holdings to physical ETFs or vaults to evade rule change risk. If you've participated in these squeezes or hold physical, share in the comments what you're seeing on the ground. Dealer premiums, delivery delays, that contradicts the paper narrative. The geopolitics layer adds pressure. Venezuela's regime change in late 2025, framed as countering Chinese influence, secures oil but ignores silver's role in energy transition. BRICS nations, accelerating de-dollarization, hoard metals. Central bank gold buys hit records, but silver's byproduct status, mined mostly from copper and lead operations, limits supply elasticity. Mines can't ramp fast. Recycling hits walls at current prices. Elon Musk warned of China's ban skyrocketing costs, as silver's indispensability in EVs and data centers creates inelastic demand. Meanwhile, U.S. manufacturers face procurement bottlenecks, paying above spot to secure allotments. This isn't growth. It's a razor's edge where one failed auction, or COMEX delivery standoff, cascades into broader disruption. Deeper. The diversification mirage BlackRock warns of applies here. Traditional portfolios assumed stocks and bonds moved inversely. Now correlations turn positive in crises. Silver was the outlier, but banks' control kept it correlated to fiat risks. As that breaks, it becomes the true diversifier. Tangible, industrial, monetary. Yet regulators stay silent. CFTC probes precious metals rigging hit at least 10 banks, but enforcement lags. Janet Yellen's January 5, 2026, speech on fiscal dominance, debt overwhelming monetary policy, echoes in metals. Rate hikes explode interest bills, forcing more borrowing, pushing yields higher in a doom loop. Silver's rally tests that. If yields spike to 6 to 7% to clear treasury auctions, banks' balance sheets crack, unloading more paper silver to raise capital. This process is unfolding now, not in some distant projection. Holiday thin trading amplified the December smashes, but volume returns this week with index rebalancing. Bloomberg Commodities Index adjustments could force $5 billion in silver sales starting January 8, 2026, unrelated to fundamentals. That's mechanical selling into a deficit market. Perfect setup for volatility. Miners like Pan American and First Majestic report record profits, yet stocks lag the metal, signaling institutional catch-up. If you're tracking miners or commodities, drop your interpretation in the comments. Does this lag signal caution or a coiled spring for re-rating? Interweave the military angle. Silver's conductivity makes it vital for munitions, radar, hypersonics, geopolitical tensions, Ukraine, Middle East, strained supplies, with U.S. stockpiles undisclosed but likely tight. Historical crises like 2007 to 2009 saw metals swell as safe havens, prompting central bank suppression via negative rates and debasement. Today, with debt to GDP over 120%, that playbook falters. BlackRock's bet. Private sector thrives via AI, public sector drowns. In silver, that's industrials winning, speculators adapting, banks retreating. The term premium BlackRock highlights extra yield for long bonds, mirrors silver's rising scarcity premium. For years, it was near zero. Investors accepted low returns assuming endless supply. Now, with deficit structural, premiums demand compensation. Domestic buyers maxed out. Foreigners diversify into BRICS assets. Who's left? Only if prices rise significantly. BlackRock's underweight on treasuries is a hedge against failed auctions. In silver, it's avoiding paper blowups. This isn't doom, it's forensic. The kill switch, margin nukes, aim to preserve control but expose the fracture. Paper crashes, physical holds. Banks' desperation, $4.8 billion losses, exits from COMEX. The math, annual interest on US debt at $1.2 trillion, refinancing $9 trillion soon, parallel silver's rollovers failing, one struggling auction and yield spike, crushing regionals, 2008 redux, but in metals. Where does capital flow? BlackRock stays overweight tech equities, seeing productivity outrun debt. In silver, that's miners and physical over futures. They prefer Canadian, Euro bonds for diversification. Similarly, silver offers uncorrelated returns. Gold tactical, but silver's undervaluation, still below 1 to 50 gold ratio historically, screams opportunity. Alternatives: private credit, infrastructure, tangible like silver bars. Triggers loom, debt ceiling. March 2026, potential failed treasury auction. Q2, Moody's downgrade watch. In silver, China's ban bites, forcing Western rerouting. COMEX open interest test vaults. Basel penalties force more exits. If you spotted similar signals in other commodities or debt markets, write your take in the comments. Does this feel like 1980 containment or 2008 contagion? The system's losing sustainability, where paper exceeds physical 250 to 1. Earlier mechanics worked with compliant leasing. Now, refusal dominates. Owners hoard, industrials preempt, speculators pivot to vaults. The narrative flips, not shorting silver, but shorting the manipulation. Protocols emerge organically. Don't fight the institutions, yet follow their pivot. Reduce paper exposure, rotate to physical or short duration equivalents. BlackRock's tactical underweight, 6 to 12 months. Silver's analogous, downside in futures, upside in bars. Build liquidity, 10 to 20% cash for dips. Hard assets, 5 to 10% silver allocation, not for riches, but survival. This divergence widens chaos. $38.5 trillion debt a trap, 300 million ounce deficit a chasm. Banks positioned away from the blast. Margin hikes their lifeboat, but it leaked. Media silence. Slow motion math doesn't televise. But signals scream, vaults drain, premiums soar, rules bend then break. If this resonates with your market observations, perhaps unusual dealer activity or institutional shifts, share in the comments why you think the physical paper gap persists. The phase, transition. Not collapse tomorrow, but erosion now. Industrial scramble intensifies. Paper credibility erodes. Institutions adapt. Retail awakens. The kill switch fired, but the target evolved. Control slips. Reality asserts. Watch the bids in Shanghai. They dictate next. The COMEX silver futures contract for March 2026 just settled at 76.750 after dropping 5.29% in a single session on January 7, 2026. That's a 4.289-point plunge from the previous close, wiping out gains accumulated since the holiday reopen. Yet physical dealers in Shanghai quote equivalents above 85, with good delivery bars carrying 6% premiums and 1-ounce coins pushing 12 to 14% over spot. Japan and UAE reports show isolated trades at 130 per ounce when inventory surfaces at all. This isn't volatility smoothing out. This is the fracture line widening. Paper prices engineered downward, while real metal commands escalating scarcity premiums that no margin adjustment can contain. The mechanics are now transparent. CME issued 3 margin hikes in December 2025 alone, 10% on the 12th, another on the 29th, and a 30% escalation effective December 31st, pushing initial margins to 32,500 per 5,000-ounce contract and maintenance to similar levels for non-speculative accounts. Speculative positions faced even steeper increases, up to 35,750. These weren't routine volatility buffers. They coincided precisely with open interest testing vault capacity and delivery notices spiking. The intent: force liquidation of leveraged longs before January maturities force physical settlement. It echoed the 1980 playbook, but failed faster. Back then, speculation drove the squeeze. Today, it's inelastic industrial intake. Solar at 290 million ounces projected for 2026. Electronics and EVs adding another layer that refuses to yield to paper pressure. China's licensing regime, activated January 1, 2026, sealed the supply-side rupture. Only 44 approved exporters control 60 to 70% of refined flows, requiring minimum production thresholds and credit lines that sideline smaller players. Beijing exported over 4,000 tons in the first 11 months of 2025, while importing just 220 tons. Net exporter status flipped to strategic hoarder. The policy isn't isolation, it's prioritization. Domestic solar, chip fabrication, and AI infrastructure consume the metal at rates that render exports a liability. Shanghai premiums jumped to 12 to 13% over LBMA/COMEX benchmarks overnight. When the world's dominant refiner gates its output, Western vaults don't refill, they drain. COMEX registered stocks already hovered near decade lows pre-holiday. Post-New Year delivery reports show aggressive standing for metal, not cash settlement. This decoupling exposes the core instability. Paper to physical ratios, historically cited at 200 to 300 to 1, no longer function when delivery pressure mounts. Basel III's 85% RSF on unallocated silver forces banks to reserve capital against paper promises, eroding the economics of short suppression. Major players retreat. Reports confirm exits from COMEX silver trading by institutions long dominant in the space. Their legacy shorts, once profitable via leasing and rehypothecation, now face margin calls at tripled spot levels. One major bullion bank disclosed unrealized losses approaching billions on silver derivatives in late 2025 filings, though specifics remain obscured. The Fed's emergency repo injections, tens of billions labeled market stability, arrived amid whispers of failed margin calls at 2 a.m., triggering algorithmic cascades. If your institution tracks repo flows or metals collateral, describe in the comments what patterns you've observed in funding pressures since December. BlackRock's 2026 outlook, buried in December 2025 releases, never explicitly names silver, but signals the pivot. They remain tactically underweight long-term U.S. Treasuries due to debt servicing exceeding $1.2 trillion annually and buyer exhaustion. Foreign holders retreating, domestics maxed. Yet overweight U.S. large-cap equities, particularly AI infrastructure, plays generating real cash flows. The thesis: private sector productivity outpaces public sector insolvency. Precious metals fit as tactical diversifiers with unique drivers, independent of correlated stocks, bonds. Gold receives the nod outright. Silver, undervalued at ratios near 60 to 1 against gold historically, amplifies the asymmetry. When BlackRock prefers Eurozone or Canadian bonds to U.S. debt, it's a proxy vote against dollar hegemony. Silver becomes the sharper instrument, industrial utility plus monetary hedge, in a world rerouting reserves toward BRICS metals accumulation. The parallel to treasuries is direct. U.S. debt at $38.85 trillion demands $7.6 trillion in rollovers over 2026 to 2027. Foreign buyers, China, Japan, diversify into gold and silver instead. Domestic absorption hits limits under regulatory constraints. Failed auctions loom unless yields spike, crushing bank balance sheets holding low coupon paper. Silver mirrors this. COMEX promises exceed deliverable metal. Margin hikes aim to defer the reckoning, but they accelerate physical flight. Industrial buyers, solar at projected 450 million ounces by 2030. AI hardware inelastic, pay any premium. Retail shifts to allocated storage or ETFs, settling physical, not cash. The system loses control where leverage meets scarcity. Historical mirrors sharpen the view. 1980s, Silver Rule 7 crushed a speculative corner. 2025 to 2026's hikes target structural demand. It backfired. Prices corrected mechanically. Holiday-thin trading amplified, but fundamentals hardened. Shanghai bids dictate reality now, not COMEX settlement. Geopolitics layers in. U.S.-Venezuela tensions secure oil, but ignore silver's defense conductivity. Munitions, radar, hypersonic strain stockpiles. BRICS de-dollarization accelerates metals hoarding. Central banks bought gold records. Silver follows as byproduct limits cap mine elasticity. The phase intensifies. Index rebalancing. Bloomberg Commodity Index adjustments. January 8th to 14th, 2026. Forces billions in mechanical silver futures sales, unrelated to supply reality. Perfect volatility setup into deficit. Miners report record margins, yet lag metal price, signaling institutional lag. Here the divergence bites. Paper erodes credibility. Physical asserts dominance. If you track miner equities or physical availability, write in the comments whether this feels like coiled re-rating or prolonged caution. Trigger stack. Debt ceiling, March 2026. Potential treasury auction failure, Q2. Moody's downgrade watch. In silver, Licensing bites deeper, forcing reroutes. Vault tests escalate. Basel penalties drive further exits. One contested delivery standoff cascades. The kill switch misfired. Not containment, but exposure. Institutions adapt quietly. BlackRock overweight tech equities for productivity escape. Underweight treasuries for fiscal trap. In metals, physical over paper. Silver's dual nature the edge. Tactical 5 to 10% allocations emerge. Not speculation, insurance. Liquidity preserved for opportunistic entry when forced sales peak. This erosion continues. Not overnight collapse, but grinding loss of paper primacy. Industrial scramble accelerates. Premiums embed as new floor. Rules bend, then shatter under reality's weight. Shanghai bids lead, COMEX follows or fades. The transition locks in. Watch the physical flow. It no longer lies. If unusual dealer behavior or institutional repositioning matches your view, share why the gap holds in the comments.